Welcome back. We're now going to put together all of our knowledge that we've learnt about the statement of comprehensive income in the previous two videos and put it all together in one big example which really looks at everything to do with adjustments to the statement of comprehensive income. So, in your notes then, we've got our example, which is Palm, and Palm acquired 80% of Swift on the 1st of October 2011 for $10 million. So, of course, then, Swift must be the subsidiary and Palm must be the parent. We have control. Remember, that's a key word in subsidiary and group accounting. Now, note then that the 1st of October 2011 is the acquisition date. So I always make a note of that, particularly if I'm asked to do a statement of comprehensive income, because there may be a mid-year acquisition. 10 million then would be the cost of the investment. The following statements of comprehensive income are available for both companies for the year ended the 31st of December 2011. So how long have we held the subsidiary for up until the year-end date? How many months post-acquisition? 3 months. Remember, you don't get marked for your workings in this paper, so you need to be careful with the number of months that you've held the subsidiary for carefully. I always count on my fingers. So, all of October, all of November, all of December, 3 months post-acquisition. So we can see then that we've got a largely abbreviated statement of comprehensive income, parent and sub, Palm and Swift, sales, cost of sales, gross profit, admin expenses, profit before tax, tax expense and profit for the year. Standard stuff there. Now I will make a note at this point that I'm not entitled to the entire year's worth of Swift's profits. The group, the owners of the parent, will only want 3 months' worth out of the 12 months of the year post-acquisition profits. Anything earned before then, well, we weren't a shareholder and therefore we wouldn't be entitled to anything pre-acquisition. So we always pro-rata for the length of time we've held the sub post-acquisition. So the following notes are relevant then. During the post-acquisition period, Swift sold $5 million worth of goods to Palm at a markup of 25% on cost. A quarter of these goods are in inventory at the year end. Could you guess what sort of adjustment we'd have to do? You guessed it. It's the PUP adjustment. The parent is receiving goods from the subsidiary. So the sub sold to the parent, Swift sold to Palm. And we can see then that total sales post-acquisition were 5 million. Now you see that we're going to do a statement of comprehensive income. We also now need to recognise intercompany sales and purchases and eliminate them from the consolidation schedule. Okay? So not only do we have a PUP adjustment based on the amount of goods left in the group at the year end, a quarter, well, we also have to consider the total sales post-acquisition and eliminate 5 million from Swift sales and eliminate 5 million from Palm's cost of sales. For the same figure, one company's sale is another company's cost of sale or purchase. 2, assume profits accrue evenly over the year, so the same amount of profit has been earned in the subsidiary each year. We assume that anyway, 3/12. Required. Prepare the consolidated statement of comprehensive income for the year ended the 31st of December 2011. Okay, so that's what we're going to do then. We are going to prepare a full statement of comprehensive income. So, for this example then, we're going to head it up appropriately. Palm, group, so the name of the parent, group, consolidated statement of comprehensive income for the year ended the 31st of December 2011. Remember then that we have 4 columns including a narrative. We have the parent column, Palm, the subsidiary column, Swift, the adjustments column, and then the group column, all expressed in thousands of dollars. We didn't really need to do a group structure, really, did we? It was pretty obvious what the group structure was. But how about we just write it in before we continue on and just make sure we do have a subsidiary and we are right with the mid-year acquisition. So really I would do this first and then do the pro forma. So this would really be step 1 and the pro forma would then be step 2, which we'll finish off in a moment. So we've got Palm, who acquired Swift. It was an 80% holding on the 1st of October 2011, held for 3 months, with the other 20% being the NCI. Okay? So it's a very simple group structure, and it will always be that way in the examination. We're only at F3, so it'll be a very simple group structure. So we've done our group structure then. We know we've held the subsidiary for 3 months post-acquisition, and I suppose we've also identified the NCI. So, back to our statement of comprehensive income then. This would be very much step 2, in the same way that the statement of financial position is. Now we know we have control over Swift, we can now proceed to consolidate the parent and the subsidiary's results. But remember, being careful that the subsidiary we must pro rata for 3 months out of 12 for the year. So, starting off then with revenue, parent plus 3/12 of the sub. And note, I've made a note of this 3 months 3 times over. Group structure, on the question, and on the actual answer itself. So I absolutely have no chance of forgetting to pro rata the subsidiary's revenue of $80,000. So, starting off then with revenue. Parent, $110,000. Subsidiary, well, it would be $80,000 times 3/12. I'm not going to write up the working every time, but just so you see where I'm getting the figures from. So 3/12 then is essentially the same as a quarter, so that would be 20,000. That's it. We'll then do cost of sales. Parent, 50,000 plus sub 30,000. Be careful. The subsidiary we pro rata 3/12, so 30,000 times 3/12, that should give you 7,500. And make sure you put them in brackets and take them off. It's cost of sales. Now what you're also going to do is add in an extra line called PUP. It's the only extra adjustment that would need to be adjusted in the parent or subsidiaries column. So we always add in that extra line, and we always need to work out PUP. Now you may not always have PUP in the exam, but it's worth putting in that line just in case. Moving on then, we'll have gross profit. Parent, sub and group. And at this time, we can't add it down because we're not finished the question. Next line from the question. Administrative expenses. Parent plus 3/12 of the sub. So, admin expenses. Parent 20,000 plus 3/12 of 35,000. 8,750. Next line then. Profit before tax. And whilst we're here, let's consolidate the tax expense as well to get profit for the year. So, profit before tax, you don't consolidate, just merely cast down. The tax expense is an expense and you consolidate that. Parent plus 3/12 of the subsidiary. 1,250. Remember, I'm not adding across just yet until I'm done. That's going to give me profit for the year, parent, sub, and group. Now, that's merely just copying from the question and proratering the subsidiaries' results post-acquisition. What we must remember to do, though, is to do the profit split and show the profit attributable to. Well, it's going to be shared between the non-controlling interest, or NCI, and the owners of the parent. In other words, the parent shareholders. Owners of the parent will always be a balancing figure, and I've wrote a little beta there to represent it as the balancing figure. At the bottom, we're going to have the group profit. And then the NCI, they are going to get 20% of the subsidiary's profit after tax. This figure here. We don't know what that is yet, so we'll leave that blank. Okay. So step 1, group structure. Step 2, consolidating the statement of comprehensive income, being careful to prorata the subsidiary's results if it's a mid-year acquisition. Now what we can do is proceed to our workings. So, step 3 is your workings. And we're not doing a statement of financial position, so we don't need net assets list, we don't need goodwill, don't need NCI, don't need group reserves. All we need is just some workings for any adjustments we may need to make. And the only real adjustment that you could see with a statement of comprehensive income is intercompany trading and also a PUP adjustment. And we saw that in the notes. Now, we said that during the post-acquisition period, Swift sold $5 million worth of goods to Palm. Stop there. We need to eliminate those post-acquisition sales between group companies. So, intercompany sales. Do you remember the journal entry for that from the last video? We debit and reduce group revenue or group sales, and that will be with 5 million. My workings will always be in thousands. So included in Swift's revenue is 5 million that is income from the parent, but not true income for the single entity, the group. We need to strip it out. in the parent's cost of sales, they're going to recognise a purchase from the subsidiary of 5 million. Again, we need to strip it out. And we're going to credit group cost of sales of 5 million. Notice I'm not identifying parent or sub-revenue or cost of sales because they get added together anyway, don't they? Yeah. So it is the group revenue and cost of sales. So let's then move that into the pro forma we did in step 2. And this is really our only use for the adjustments column. We debit and reduce group revenue by 5 million, the intercompany sale, and minus 5 million from cost of sales, intercompany purchases. Don't get confused by the negatives and pluses. You're reducing an expense, thus increasing profit. Okay? So 50,000 plus 7.5 minus 5,000, and then we'd adjust for the PUP to get group cost of sales. That's all you do. Any sales post-acquisition, take it out of revenue, out of cost of sales. All right? So we do that in the adjustments column. Finally, then, we deal with the PUP. We've been told the transfer price of 5 million. We've been told it's a markup of 25%. We know who made the profit, the subsidiary, and a quarter of those goods are left in inventory. We will need to do a calculation now for the PUP. So, in our workings, PUP adjustment. First thing we consider, who made the profit? Well, it was a subsidiary, wasn't it? Sub sold to parent, Swift sold to Palm. Step 2. Inventory left in the group. Quarter of the goods are left within the group, which means 3/4 of those sales at 5 million have been sold, so a quarter of those goods are left. Okay. So that would mean then that $1.25 million worth of goods at a transfer price with a markup are still left within the group. So, we calculate the PUP, transfer price, cost, and the provision for unrealised profit. We know it's a 25% markup up on cost. So we base it on cost, where the transfer price is cost plus markup, 125, and the PUP would be the other 25 dropping out of the bottom. Now remember, the transfer price is the transfer price of the goods left in inventory, not total sales. We said that a quarter of the transfer price is the value of goods left in inventory at 1,250. So, why don't you have a go at calculating the PUP yourself? Pause the recording whilst you're doing that, and then unpause the recording when you're ready to go through the answer. So, PUP then, 1,250 transfer price, divide it by 125 that it relates to, times it by 25, and that's going to give you 250 as your PUP, which means the cost as a balancing figure must be that $1 million, the balancing figure. Now, when we did this in the statement of financial position, we said debit retained earnings and reduce down the selling company's retained earnings, and credit and reduce group inventory. Now, we're thinking about the impact on profits only. Now, when we say debit retained earnings, well, that's reducing profits. So whose profits are we going to reduce with this PUP? Well, it's the subsidiary's profits. And as such, in our consolidated statement of comprehensive income, we are going to deduct the PUP of 250 from the subsidiary, the selling company's column. And effectively, you're adding it to cost of sales, increasing an expense, which then reduces group profit. So, there we have it. We've dealt with all the notes. We've prorated where necessary. Now, we just need to add across. So, parent plus sub minus intercompany is going to give you 125 million as group revenue. Group cost of sales then will be parent plus subsidiaries cost of sales plus the PUP, the fake profit on the goods left within the group, minus the intercompany purchases. So add the three minuses together and take off the plus. I know it sounds a bit bonkers, but add together everything that increases cost of sales and take off the intercompany purchase. That's going to give us $52,750 as group cost of sales. Oops. So if we add that down then, group gross profit is 72,250. Parents' gross profit will remain at 60. And for the subsidiary, that's going to give us 12,250. Check then that the two gross profits for the parent and sub add across and equal the group gross profit. Notice the intercompany sales contour each other out, and we never need to add up the adjustments column because they'll always net each other off. Group admin expenses, 28,750 adding across. Admin expenses minus the gross profit, or gross profit minus the admin expenses, will give us 43,500 group profit before tax. That's obviously 40,000 profit for the parent before tax, and then 3,500 subsidiary profit before tax. We've then got tax for the group of 11,250, which gives parents net profit or profit for the year of 30. 2,250 profit for the sub, and then add down for the group as well. Will give us 32,250. Okay, so all the hard work's done. You just add across and add down. Now what we need to do is share that group net profit between the owners of the parent and the NCI. So the first thing we're going to do then is insert 32,250 group profit for the year at the bottom. Now we've got to say who should have that profit. Well, the NCI is going to get their share, 20%, of the subsidiary's profit in the year. Remember, the NCI own the subsidiary, or own 20% of the subsidiary. They do not own 20% of the parent as well. So, 20% of 2,250 is what we're going to give to the owners of the non-controlling interest in the subsidiary. And that's going to give us 450. So, of that 2,250, the NCI will get the 20%. And then the owners of the parent, the shareholders of the parent, will get all of the parent's profit plus 80% of the subsidiary's profit, or the balancing figure. So if you take the group profit of 32,250 and minus 450, the profit that we're going to give to the NCI, the owners of the parent then must get the other 31,800. And that would be the balancing figure. And there you have it. A group statement of comprehensive income done. You could be asked for any of these figures in the exam as a 2-mark question. But what I think would be most common is you're given the subsidiaries and parents results in the same way here. You're asked to calculate the PUP, which would affect the subsidiaries' profit. And then, as a result, the requirement of the question would be calculate the share of profit attributable to the NCI. So with a bit of practice on this, statements of comprehensive income are really a lot nicer than the statement of financial position for the group. So our final session then will be on associates, and that will just be a bit of theory to roll up this chapter on consolidated financial statements.